we're now going to turn our attention to bookkeeping and accounting and what these terms mean. When we talk about bookkeeping, what are we talking about? When we talk about accounting, what are we talking about? Then we're going to start the process of looking at how it is that we're going to record all of the transactions that a company undertakes and how it is that we're going to put all of this information that we're collecting into what will ultimately become our financial statements. But we're going to start by talking about what is bookkeeping. And bookkeeping is very simple. It's the process of recording financial events in an accounting system. Okay? All those transactions, all of those financial events that a company has, they need to be recorded. And bookkeeping is that process of recording these transactions. If we take a small business, they might have 5, 10, 15 transactions a day. But when we turn our attention and look at a large multinational, it's hundreds of thousands, millions of financial events every day. And every one of them needs to be recorded as a transaction in their accounting system. And so when you go to the store, you go to a restaurant that's a chain restaurant across the world, every time a customer buys something, it has to be recorded. We need to record what they bought, how much they paid, how much the company paid for what it is that they sold to them. So there's all of these transactions that need to be recorded, and that's the process of bookkeeping. And specifically within bookkeeping, we need to look at what is double entry bookkeeping. Okay, this is what we do when we talk about accounting and bookkeeping. It's double entry bookkeeping. And it's called double entry because we're going to record all of these financial transactions in 2 ledger accounts. And we'll come back and we'll build up what all these ledger accounts are and things like that. But in this double entry system, we're going to record each transaction in 2 ways. Okay, looking at it from 2 sides, that double entry part. And this double entry system that we're using is what we use to maintain the balance of the accounting equation or the accounting formula. And we're going to keep building up on this as we go through. But the accounting formula is very simple. It is that the assets of the company must be equal to the liabilities plus the equity of the company. The assets are what the company owns. Cash, receivables, inventory, fixed assets. Okay, what it is that the company owns, what belongs to the company. Liabilities are what the company owes to other people. Okay, they owe money to their landlord for rent. They owe money to their employees for salary. They owe money to a marketing company for marketing support. The liabilities are what they owe to other people. And equity is what they owe to the owners of the company. In the case of a corporation, it's the shareholders. In the case of a partnership, it's the partners. In the case of a sole proprietor, it's that individual business owner. Those claims on the assets of the company that the owners of the company have. So all of the assets of the company, all of the things that the company owns, are either owed to other parties in the form of liabilities or to the owners of the company in the form of equity. So this is our formula. Assets equal liabilities plus equity. Well, we can move this around. We can make this in other ways, and it still balances. We can say assets minus liabilities equal equity. Or we can say assets minus equity equals liabilities. Okay, it's just a mathematical equation, and we're just moving those elements around a little bit from one side to another. But this accounting formula, this accounting equation needs to be kept in balance. It always needs to be true. Assets need to equal the liabilities plus the equity. And so every time we make a journal entry, every time we record a transaction, we need to make certain that that individual journal entry, that individual transaction balances. And we'll look through some transactions here, but we may have transactions where the assets go up and the liabilities go up. That's fine. If the assets go down, then the liabilities or the equity must go down. But within each individual transaction, we need to have this balance. And so, if every transaction individually balances, then the total should balance as well. Okay, kind of a constant way of checking here. We need to make certain that each individual transaction balances, and if each individual transaction balances, then the total should also balance as well. So we said that bookkeeping is the recording of the transactions in the accounting system. Just recording those transactions. So what is it that is accounting then? If we have bookkeeping and we have accounting, and bookkeeping is the recording of the transactions, what is it that we have as accounting? Well, accounting is a lot more than just bookkeeping. Accounting involves the design of accounting systems, the preparation of financial statements, auditing, the development of cost studies, forecasts, other analytical work, income tax work, and the analysis and interpretation of accounting information to provide support for business decisions. The way I look at it is this. Bookkeeping is the recording of the transactions, writing down what happened. Accounting is the process of taking all of that information and giving it value. Taking all of that information to prepare the financial statements. Taking all of that information to provide information for business decisions. What price should we charge? Do we want to go into a new market? Should we continue this product line? Should we stop that product line? All of those decisions that a company makes are being supported by the information that comes out of the accounting system. So bookkeeping is recording those transactions and all of those events that take place, and accounting is making that information have value to the organization. Now, most companies use an automated accounting information system, or an AIS. And a lot of these automated systems really don't require a lot of knowledge about double entry bookkeeping because the accounting system creates those entries automatically. Okay, someone just comes out of the recording system in the store, builds in all of those journal entries for us. But even though we may not need to have a lot of understanding of the double entry bookkeeping process to create those journal entries, this understanding of it is necessary to understand what that automated accounting system is supposed to be doing. If we understand what that system is supposed to be doing, we may be able to identify when something's not quite right, when maybe the system isn't programmed quite right, or it's not handling a specific transaction or situation quite right. We need to have that information, that knowledge, so that we can understand whether or not that accounting system is providing the information that we need and if it's doing it correctly. So what we're going to do now is we're going to turn our attention just at a very foundational level to looking at how it is that some transactions are going to be recorded. Now, we already said that every financial transaction that's recorded in a double entry system must affect at least 2 ledger accounts. And so what we're going to do is we're going to go through a handful of transactions here and just show how we keep this accounting equation in balance. If we have an asset that increases, we need to also either have a liability increase, the equity increase, or a different asset decrease if we want that transaction or that formula to continue to be in balance through each transaction. So what we're going to do here is just the foundation. We're not going to make the journal entries. We're just going to look at different categories of transactions and see how it is that we keep that accounting equation in balance. So the first transaction we have is a change in assets only. So it increases one asset account balance and decreases another asset account balance. No change to liabilities, no changes to equity. Just one asset account goes up and another asset account goes down. For example, a piece of equipment is purchased for $10,000 in cash. That equipment is an asset, and so is the cash. So our equipment account goes up by $10,000, and our cash account goes down by $10,000 because we have 10,000 fewer dollars, total assets remain unchanged, and our equation stays in balance. Now, we also can have a transaction that deals with only liabilities. Okay, it has only liabilities involved. So one liability account goes up and another liability account goes down. So no change in total liabilities, no change in assets, no change in equity, and our accounting equation remains in balance. So, for example, a company has a short-term loan for $15,000 that's maturing. The company borrows $15,000 on a long-term loan and then uses the cash, the proceeds from that long-term loan, to pay off the short-term loan. Now, both of those loans, the short-term and the long-term loans, are both liabilities. So short-term liabilities are being decreased and long-term liabilities are being increased, both by $15,000. One liability goes down, one liability goes up, liabilities remain unchanged, and our equation stays in balance. Now, we can also have a situation where we decrease both an asset and a liability. Okay? We decrease an asset account, we decrease a liability account by the same amount, and so our equation stays in balance. Looking at our example, $20,000 in cash is used to pay off a $20,000 short-term loan that is maturing. The loan is a liability. We owe it to somebody else. Well, when we pay off that loan is decreased by $20,000. But how did we pay it off? Well, we decreased our cash by $20,000 as well. So, assets go down, liabilities go down by $20,000 each, and our accounting equation continues to be in balance. Now, we can also have a situation where our assets increase and our equity increases. The asset goes up, equity goes up, and our accounting equation stays in balance. The example for this is common stock is sold to investors for $50,000 in cash. That cash is an asset. So we received $50,000 in cash. So cash goes up by $50,000. But those owners say, well, we're the owners, we have a claim to that, and so the equity account is going to go up by $50,000 as well. Assets go up by 50, equity goes up by 50. The equation stays in balance and everybody stays happy. Okay. This is just the foundation. We'll come back and we'll build on these transactions with the debits and credits and the actual names of the accounts that they're going to go to. But right now we're just setting up what's happening with bookkeeping and accounting. Bookkeeping is the recording of all of those transactions. Okay, recording all of those transactions that the company undertakes. The accounting process is giving life, giving color, giving value to all of the information that we've recorded as we record all of those transactions. And we laid the foundation here using our accounting equation. Assets equals liabilities plus equity. Every individual journal entry needs to balance. That formula needs to stay the same. And if every individual account, every individual journal entry is balanced, then all of it is going to be balanced when we put it all together. This is just the foundation, and as we keep going, we're going to build out. We'll talk about the chart of accounts, how these accounts are going to be numbered. We'll talk about the debits and the credits and how we do these journal entries with the debits and credits. But right now, we're just laying the foundation for this.